Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenovec from Bloomberg Radio.
Okay, call it what you will. An orthopedic shoe company, a luxury fashion house, or even a healthcare company. Birkenstock has staying power. It's the favorite ugly shoe of many, from hippies to hypebeasts, and yes, to Steve Jobs.
The company has seen many ups and downs in its 250-year history and capped off a decade of explosive growth with an IPO last fall, making Christian and Alex Birkenstock, the two brothers who are seventh-generation members of the German footwear dynasty, billionaires.
For the forthcoming issue of Businessweek magazine, Bloomberg News European healthcare and consumer reporter Tim Lowe profiles Birkenstock and the man responsible for the company's explosive growth. You can read Tim's story on the Bloomberg terminal and at bloomberg.com/businessweek. Tim joins us now from Munich, Germany. Tim, I mentioned the Birkenstock brothers, or just Emily just did just now. Alex and Christian, who are now billionaires, but there's a man who's not a Birkenstock, who is responsible for the company's recent growth. Who is Oliver Reichert?
Yeah, Oliver Reichert is a really fascinating character. He is not from the footwear industry. He is brought in. He's a former journalist. He's German. He's about a 6'6" tall. He's and not skinny. He's a big guy with a beard, a deep voice, a big personality. And so he's this ex-journalist who randomly, back in about 2008, got introduced to Christian Birkenstock, who at the time was in the midst of this massive kind of squabbles with his two brothers and father over control of where the brand was headed. And Oliver Reichert, who's now the CEO of the company, sort of was a friendly ear to Christian, helped him sort through a couple problems early on. And then Christian hired him to be sort of his personal consultant. And Oliver's got a very powerful personality, and he sort of came in and helped sort through the Birkenstock family problems, which were massive. And basically since 2013, he's been basically steering the ship, and the company has grown, I think, fivefold since then. It's been on a 20% a year sales growth trajectory, very profitable. And it's really been his baby over the last decade and continues to be now that they're a publicly traded company. A really fascinating man.
It's really been a remarkable trajectory, Tim. And this story really gets all into it. I encourage all of you who are listening to read it, and talking about all these different upstarts along the way, like Crocs and these other brands that were coming in. It sounds like you've met with Reichert. I'd love to hear more about like your reporting for this story, because he really, like you said, is such a character. Even you said akin to a bully in this story, which I thought was kind of interesting.
Sure. Yeah, that's a word that I heard repeatedly in my reporting, talking to people who have either worked for him or have, sat across the negotiating table from him. Certainly a strong personality, as I've mentioned. And I kind of think it requires such a character to kind of wade into this family drama as he did about 10, 15 years ago and survive. I talked to one German local marketing professor here in Munich who, basically described the role of a turnaround guy from outside who comes into a traditional family business in Germany. And, one might call that in German a Himmelfahrtsmission, which is basically like a suicide mission. So Oliver came in.
One might. We believe you, Tim. We believe you.
He managed to survive it. Not just that, but thrive. So it's kind of evident in him. I think it's kind of his personality, a very strong-willed individual. He, with his journalist background, I think he was, when he came in, he spent a lot of time sort of trying to distill the essence of what it is he thought the brand was and can be. And since that sort of crystallized to him, he's been, he's an individual who can sort of push through
We're working to get Tim Lowe's audio back out there in Munich, Germany. Again, as Molly mentioned, it's worth checking out this story on the Bloomberg terminal and at bloomberg.com/businessweek. And if you're thinking to yourself, okay, 7 generations of a family business, sounds like I need maybe a family tree to kind of understand what's going on. Well, you're in luck because there is a family tree in the piece. It starts with Johannes Birkenstock back in 1749 and goes all the way to Suzanne Birkenstock, who was formerly Suzanne Papenbrock, born in 1971. And that's exactly where I want to go, Tim, because I know the last 15 years for the company have been incredibly important for where the company is now, but the company does indeed go back to the 1700s. So I don't want to get tied up too much in the history, but give us the sort of, 2-minute history version of Birkenstock as a company. And I want to particular focus what happened with Carl Birkenstock before the current generation took it over.
Sure. Yeah. As you said, back to the 1774 is when the first evidence is of a Birkenstock in the Frankfurt area who's listed as a kind of a cobbler who makes shoes. And really, the first 100 years, not a lot happened. There was a bunch of cobblers that were trying to make shoes. It was a trade route that they were on, so a lot of salespeople walking to and from, and they needed new footwear. Nothing quite big happened. But around the turn of the century, 1900, there was a character, Conrad Birkenstock, and he really invented the elements that became the Birkenstock footbed. And he had a couple of innovations, a flexible insole in people's shoes. Back in those days, shoemakers didn't differentiate between your left and right foot. Conrad Birkenstock did. So that was a major breakthrough.
That is wild.
Like
Wait, we're doing like literally walking around with 2 left feet.
It's an incredible innovation.
Exactly.
That's crazy.
And he thought this is crazy. And he kind of invented a new way to make the shoes. You would think it might catch on. It didn't. He struggled to find customers for this. His son, Carl, with a C Birkenstock, he took his dad's innovations and he himself tried to find new ways to market it. His ambition in life was to create what he called an ideal shoe, which would incorporate all the family kind of innovations into one mass producible product. He failed at that. It was his son, Carl, with a K Birkenstock in the early 1960s, who had the kind of the eureka moment where he said, hey, if we put these, innovations into an open-toed sandal, suddenly we can mass produce this. And so that's what he did. It was the early 60s. He created basically all the designs that we know today. Even then, people thought they were ugly, but even then they had hardcore fans. And Carl with a K, for the next 50 years, he kind of ruled the company with an iron fist. He had his own 3 sons, and the transition from Carl to his sons created all sorts of problems about where the company was headed. And that's kind of the 2000s. The Birkenstock was a bit directionless. Crocs was not, came out of nowhere and ate their lunch. And that kind of set the table for where we were 2010, say, when Oliver Reichert came in.
Well, thank you for catching us up on the last, 2 or 3 centuries worth of history here, Tim. That was excellent. I want to ask you, though, this is, so other Tim here in New York has been describing Birkenstock as this orthopedic shoe company. But as your headline says, the whole point of this, reinventing of the brand almost is to convince investors that it's a luxury brand. How do you square, I'm saying this as like a woman who's worn many pairs of shoes in my life, how do you square an orthopedic shoe with a luxury brand? Because to me, the two seem like totally different things.
Yeah, I think you put your finger right there on the central tension of the company right now, particularly since the IPO. What is it? And I think investors have been asking that question and trying to sort of categorize it. As a footwear brand, there's a couple things that, set it apart. It still owns all of its factories, which like no other footwear company really does. And not only that, but they're all located basically in Germany. So they never left. So that alone, sets them apart from other brands. The company is obsessed with, the footbed, as I say, and they really think of it as like the beating heart of the company. When I first met them, they thought it was kind of ironic that I have a weird beat here where I cover both like healthcare, pharmaceutical companies, and companies like Adidas and Puma. And they were like, oh, that's perfect because you're a healthcare guy and we're a healthcare company. And I was like, what? So I found that fascinating. And it's true. They say, we're a healthcare company focused on the feet, and it's there in all of their, security filings leading up to their IPO in October. They're pretty hardcore about that. And yet they've made this pivot, and they're, partnering with Dior. They sold themselves to the universe of LVMH. So they're succeeding a lot by, these very glitzy collaborations. It's working for them right now.
Yeah, it was a tough IPO, as you write in the piece, but it's been working for them recently. It seems like investors are starting to understand at least what Reichert is saying the company is. Tim, it's a great story. It's in the upcoming issue of Bloomberg Businessweek. Read it now on the terminal or at Bloomberg.com. Our thanks to Tim Lowe.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, next week, Tim Cook is going to take the stage to deliver the keynote address at Apple's WWDC, its Worldwide Developers Conference. Bloomberg News chief technology correspondent Mark Gurman writes that the keynote is Apple's biggest sales pitch in years, as the company has to convince consumers, developers, and investors, Molly, that it can thrive in the AI era.
That's right. And there's added pressure because Apple's existing business is stagnant, with revenue declining in 5 of the last 6 quarters.
So Apple's turning to none other than Sam Altman of OpenAI for some help. Mark joins us now from Los Angeles. Mark, before we get to the latest partnership and what exactly OpenAI is going to do for Apple, and more, equally as important, vice versa, give us a little bit of the history between Apple and Sam Altman, because the relationship, as you write in your piece, it goes back years to just after the iPhone was first released. Why did a then 23-year-old Sam Altman take the stage at WWDC?
So interesting. The last time that Sam Altman was involved with Apple in any public sense was, like you said, 2008. Now, let me take you back to 2008. The App Store had not yet launched. The App Store launched in July, right? Actually, July 9th of 2008. And in June, early June, they held their final Worldwide Developers Conference before that launch. To get people interested in the App Store and app development on iOS, they spent a good half, nearly an hour of that conference that year. And this was back when Steve Jobs was leading the company, bringing up different app developers to talk about their different app initiatives. And Sam Altman came up to present Looped. This was a precursor sort of to Find My iPhone, Find My Friends. It was a very well-received app. Ultimately, the app did so well that it got acquired back almost 15 years ago for about $50 million. So this was a big deal. And for Altman, this helped give him promotion to sell Looped, right? But for Apple, it also proved the App Store as a third-party application platform.
Mark, tell us why Apple is turning now to Altman in 2024 for something to do with AI. I mean, this would seem like, Apple, where I would think the biggest and brightest minds in the tech world reside. Why is it that they don't have those people in-house and that they're turning to Sam Altman for help?
I have to tell you, Molly, it's pretty embarrassing for Apple.
It seems like it is. I would think so.
Right. They missed the boat on generative AI and probably modern artificial intelligence as a whole. And it's very interesting to me that they've had to go this way and partner with OpenAI versus being able to build a chatbot in-house. So Apple will have its own large language models and different technologies to run AI on the iPhone. But for a chatbot, something that people are used to already now since the end of 2022, those OpenAI-like features, they're partnering with OpenAI to integrate that deep into the iPhone experience. They held talks with Anthropic, they held talks with Google Gemini as well, but ultimately they've landed on OpenAI as their initial launch partner. I expect them to eventually strike a deal with Gemini and others in the future. They're still talking to Google about this. But this is really interesting. I thought last year, with the introduction of the Vision Pro, that last year's WWDC was the biggest Apple launch in 5 years or so. Truth is, it's this year, because AI not only is the current, but it is the future. It's going to make their current devices better. But if they don't get their AI technology in order, they're going to miss out on the next wave of artificial intelligence-driven devices. In my Power On column this Sunday, I'm going to get into more what that means for Apple, but just to give you a little bit of a taste here. You've seen other people come out with devices sort of like the Humane AI Pin, complete failure. They're up for sale. You've seen the Rabbit R1. You've seen Samsung integrate AI into their phone, similar to how Apple's going to do so next week. But the real stuff is what's enabled by AI. Things like next generation AirPods, humanoid robots, augmented reality glasses, future versions of the Vision Pro, more advanced processors and Macs. That requires an extraordinarily sophisticated handle on next generation AI technologies. That's why this is so important. This is not about the iPhone 15, 16, 17, or even 18. This is about the product categories that don't exist yet. And if they don't get their AI in good shape, those categories will never exist.
So how are we going to get there? Because, you quote somebody in the piece, Dag Kitlos, who's a tech veteran, co-founded and ran the Siri business before it was acquired by Apple. He said that the OpenAI partnership is likely to be a, quote, short to medium term partnership. So where does Apple go beyond that? Surely there's got to be some kind of development of talent or bringing somebody in who's going to run the AI, themed projects going forward.
Yeah, Dag is completely right. So just to be clear, there's the OpenAI component, which is the more advanced AI stuff. Then there's the less advanced AI stuff. That's the first party Apple AI features. They're all going to be there next week, right? Eventually, Apple will shift the more advanced technologies over to its own infrastructure, its own AI systems. OpenAI will be there as a placeholder, I would guess, for 3 years until they're able to roll out their own chatbot, right? You want to be able to get your phone to write a letter to someone or an email to someone. You want to get your phone to be able to create an image for you, right? These are things that Gen Z and everyone else at this point is doing in the ChatGPT app. Apple doesn't have the tech to do it, so they had no choice but to partner with OpenAI. They say internally they're allergic and they have a philosophical allergy, I would say, actually, towards chatbots. They don't believe in it as a concept. They believe in this more highly integrated approach to AI, apps, privacy that you'll see next week. I have to tell you, if I'm being just very blunt with you,
Please.
I think it's an excuse for their technology not being ready. As soon as their technology is ready, their whole philosophical standpoint on this is going to shift immediately. But it's going to take some time. It is unbelievable to me that the launch of ChatGPT in 2022, the launch of Gemini or Bard previously last year, completely took these guys by surprise.
Yeah.
They did not start working on this in any meaningful way until after ChatGPT hit the market like a surprise.
Sounds like it's been catch up from the beginning.
Yeah, it's just remarkable, Mark, the way that you've painted this picture for us about Apple being caught on its back foot. Hey, I'm wondering about historical precedents for a partnership like this. I mean, the only type of partnership I can think of, and correct me if I'm wrong, is like an Alphabet Google partnership with search, where Apple really relies on the company for that. Has there ever been a precedent for what Apple's going to be relying on OpenAI for?
Tim, you are spot on. The difference is, though, that when Apple struck this Google search partnership 20 years ago, there was no expectation that Apple should be in the search business. Search is extraordinarily important to the operation of the web browser, right?
Yeah.
AI is important to the whole platform, right? It's two different ball games, so to speak. There's no risk in Apple not creating its own competitor or replacement to Google search. There's a fundamental risk to the very core of the future of the company if it is not able to get its AI up to snuff. There are serious questions from people in the Apple world about how long the management in charge of artificial intelligence at Apple is going to last if this thing doesn't get turned around. They're going to have some fancy and impressive demos on Monday, but that doesn't change the overall story about how flat-footed they were here and how behind they are. And striking an OpenAI partnership, best case scenario for them. They're getting the best tech, and they're going to have to sort of eat some crow in the short term. They had no other choice but to do this. Okay. And if investors are looking for a positive here, it's that Apple was able to eat its wounds here and get it done.
Mark, your reporting on this has been just incredible. Also, your analysis. You got to sign up if you haven't for the Power On newsletter. Mark Gurman, Bloomberg News Chief Technology Correspondent, joining us from LA.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, it's one of the most read stories on the Bloomberg terminal. It's all about David Sacks, a name increasingly familiar to those outside of Silicon Valley, but very well known inside the Valley, and how, Molly, he's going all in on Donald Trump.
Yeah, that's right, Tim. In past elections, he's donated to Mitt Romney and Hillary Clinton. He sat out of 2020 altogether and said after the violence at the U.S. Capitol that Trump had, quote, disqualified himself from being a candidate at the national level again. And then in this election cycle, Sacks has now backed Robert F. Kennedy Jr., Ron DeSantis, and he also co-hosted fundraisers for presidential hopeful Vivek Ramaswamy.
Yes, this week, Sacks will end up where most Republicans find themselves in 2024. He's going to host a $300,000 a head fundraiser for Trump.
They've all ended up there, haven't they?
Seems
one
like
by one.
It. Increasingly, yeah.
So Sarah McBride, Bloomberg News venture capital reporter, she joins us now over Zoom. Hey, Sarah, you profiled David Sacks for the forthcoming issue of Bloomberg Businessweek magazine. And this story, you can check it out on the Bloomberg and also at bloomberg.com/businessweek. So much to get into here. I mean, this is really, as you say, that David Sacks has taken a, quote, meandering path to Donald Trump. Take us, through it from the 2012 election to now.
Well, he's kind of a free thinker and he loves exploring ideas. So the way he talks about it, he is interested in hearing people's ideas and just went through a lot of different candidates. In 2012, he supported Romney. 2016, Hillary Clinton, though he says now he was just doing a favor to a friend who was hosting a fundraiser. And he got to know a bunch of different Republican candidates this time around. He helped Ron DeSantis launch his campaign on Twitter. That was kind of marred by technical problems. He is interested in hearing what they all have to say, and as one by one they've dropped out of the campaign, he is now left with the former President Trump, and he has decided he's going to back Trump. And so he's holding this fundraiser for him tomorrow.
Yeah, increasingly we've seen a lot of incredibly wealthy people here in the United States who perhaps distance themselves from the former president in the wake of the January 6, 2021 attack on the Capitol, but are now throwing their support behind him. Before we get more into the politics of this, Sarah, give us more background on David Sacks. As I mentioned in our introduction, he's pretty well known in the Valley for the companies that he's created and the venture capital investments that he's made. But take us back even before the PayPal days to what he did at Stanford in the 1990s.
Sure. So he attended Stanford, and while he was there, he got to know other people who attended Stanford at the time. For example, Peter Thiel, who was a few years ahead of him at the law school. He worked on the law review. He and Peter Thiel co-authored a book called The Diversity Myth. It's a little bit controversial because in ways it anticipated all the anti-woke rhetoric that you hear today. They had some controversial things to say that both of them later apologized for. And then he became part of the PayPal mafia, where he got to know other prominent venture capitalists like Roelof Botha at Sequoia. He was at PayPal when it went public and later got acquired. From there, he went to Hollywood for a little bit. He produced a movie called Thank You for Smoking, which was a political satire. So he's been interested in politics and influence for a long time.
Talk us about I just want
to jump in here because we're getting a headline crossing the Bloomberg terminal. Nvidia has become the third stock ever to reach $3 trillion in value. After that $2 trillion gain, Nvidia still irresistible to many. Molly, I'm sorry that I cut you off there.
Please. Yeah, thank you, Tim. All over it. Just coming back here to Sarah, though. Sarah, I wanted to ask you about this, conservative wave of enthusiasm within Silicon Valley. It seems like that's a kind of, political rhetoric that I understand would jive with a lot of like the New York City finance crowd, but maybe not I wouldn't as easily make the connection over to California, where it seems like there are a lot more liberal-minded people. So tell us more about that, conservative, echelon of people within Silicon Valley.
Sure. Well, there are a lot of people who are upset as what they see as over-regulation by the administration now. For example, there has been more concern about, will tech companies be able to get their mergers done as antitrust concerns grow more prevalent? Then there is a wave of people who think the government is spending way too much money. That also includes David Sachs. He has a lot of criticism about the Fed as well as the administration. And then the biggest issue for him personally, although other people dislike our foreign policy too, is he thinks we're involved in too much meddling overseas. In particular, he thinks the U.S. is too involved in the war in Ukraine and thinks that war should be settled via large concessions from Kiev. And he regularly rants about that. He thought that after we got out of Afghanistan, that was a very good position, even though he views that withdrawal as botched. But he said there was a period of 6 months when we had no wars, and now we're involved in conflicts around the globe, and he's worried about that. So many people in Silicon Valley share his concerns, and because of that, they want the current administration gone, and they're willing to accept a Trump administration again, regardless of whatever dissatisfaction they may have had with the Trump administration before.
Hey, Sarah, correct me if I'm wrong here, but at least my impression, and again, I want you to weigh in on this, there's like the David Sachs before the All In podcast, and then there's the David Sachs after the All In podcast. Can you talk a little bit about the influence of the podcast and to what extent it's given him this outlet to, in your words, rail against certain issues?
Sure. The podcast has really caught on. It's kind of a fun way for people to catch up on what people are talking about in Silicon Valley. It's David and three of his friends, Jason Calacanis, Chamath Palihapitiya, and also David Friedberg, and they just kind of debate the issues of the day. And they often disagree with each other. I'd say they all, except Jason Calacanis, they all kind of tend to the conservative, especially fiscally. And it's just really interesting to get the take of these smart people on whatever's happening in Silicon Valley. So because of that, they now have this platform where people are listening to them all over the world. David's never not been confident, but if anything, the validation from this podcast has given him more confidence, and he kind of revels in this attention that he's getting now.
I got to tell you, among the most read stories on the Bloomberg terminal, and just a great read, a great profile, with interviews, including with many of the men who Sarah just mentioned. So check out this story on the Bloomberg terminal, and of course at Bloomberg.com as well. Sarah McBride, Bloomberg News venture capital reporter. Her story also in the forthcoming issue of Businessweek magazine.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Charlie just talked about some of the stocks moving higher right now. Among the ones on track to close at a record high today include Hewlett-Packard Enterprise, or HPE.
And guess what? Has to do with AI.
Oh, interesting.
Never would have guessed it. And HPE reported better than expected revenue fueled by sales of servers built for artificial intelligence work. Fiscal 2Q revenue increased 3.3% to $7.2 billion. That was according to earnings that were out yesterday after the close. That's compared to Wall Street had projected a 2% decline year over year to under $7 billion. So huge beat there for HPE, according to data compiled by Bloomberg.
Well, here to break it all down is Crawford Del Prete, president over at IDC. He joins us from Massachusetts. Crawford, good to have you with us. We're going to talk HPE in just a second, but we got to start with Nvidia because it was already the world's most valuable semi firm, but now it's become the first computer chip company ever to hit $3 trillion in market cap. a remarkable rise, the last $2 trillion of the company, up 146% so far this year. Crawford, you think about this space, you work in this space you've worked in this space for years. Just give us your impressions and your thoughts on Nvidia.
Yeah, absolutely. And Tim and Molly, it's great to talk to you guys. Thanks so much for having me. So this is how I think about NVIDIA. And this is I think a little bit of a different take than a lot of people. A lot of people think about NVIDIA as a processor company. They think about a company that's selling these things called GPUs that are obviously powering next generation data centers. But it's actually a lot more complicated story. I've known Jensen for a lot of years. I've had the opportunity to sit with him and see this story come together over the last really 15, 20 years. So when I think about, people ask me all the time, what would you compare in NVIDIA to? And the best example I can think of is, if you think back to the mid-90s going into 1999 and 2000, you had this thing called a Wintel architecture, which is the combination of Windows and it was Intel. And it was together. And what we had an operating system where you wrote code in things like C or C++ or Java. And those were platforms that people wrote and created massive productivity gains on top of this Intel and Windows architecture. What NVIDIA has done is they've created a GPU with a CUDA architecture, their own proprietary software development platform that people are innovating on top of. So people think about the moat that NVIDIA has as something that is a chip moat. The reality is it's a platform moat. It's a moat that you've got developers developing software applications in the CUDA architecture that can then take advantage of the GPU architecture that NVIDIA has. And that's really, really powerful. And that's what you're seeing NVIDIA being rewarded for now, because it's going to be a very, very defensible system going forward. Now, we can talk about what Intel or what AMD or any other processor company are going to do to compete with that, but the reality is this is a very differentiated spot that NVIDIA has carved out for themselves, and that's why they're being rewarded. That, and of course, the massive demand that we're seeing.
Right. So we've got Nvidia today topping $3 trillion in market value. HPE also on track to close at a record high today. You know, Crawford, we had on before you our chief technology correspondent, Mark Gurman, talking about Apple, that they just seem to be, I mean, God knows where Apple is in this conversation. They're completely playing catch up and have been totally left behind in this AI rally. How do you fit them into this whole equation? And where is that AI growth going to come from for question. Apple? You know, after this OpenAI partnership?
Yeah, so Molly, it's a great point. And when you think about Apple, right, Apple has built a device ecosystem, and they've built it on top of the cloud, and they built a device ecosystem that's enabled all these applications. And so the way Apple is going to play here is Apple is going to be able to take advantage of all the data that they have, that they understand about people, and become much more assistive in the applications that can be created on top of Apple's ecosystem. But that means that Apple's going to have to be able to power a new set of applications on their platform that people are then going to be able to differentiate on in different use cases. So you'll get, you know, right before your very eyes, Uber will become smarter, or Zillow will become smarter, or whatever app you use on a daily basis will become more intuitive, smarter, and be able to give you better assistance at the things that you want to be able to do. That's going to take some time, and that's going to come as Apple builds out their own data centers, and also Apple's partners build out their data centers, and they enable those applications. And so Apple will be in this discussion, but quite frankly, the fact that Apple didn't have that big enterprise footprint that other suppliers have had historically, that's why they're going to be playing catch up. And that's going to happen over the course of the next couple of years.
Okay, Crawford, we talked Nvidia, we talked Apple. Now to Hewlett-Packard Enterprise. Shares are higher by 11.5%, as Molly mentioned, set to close at a 52-week high and record today if it does keep this momentum up into the close. Our own Bloomberg technology team caught up a little earlier with the president and CEO, Antonio Neri, on Bloomberg Technology. Let's take a listen to what he had to say.
We have a terrific pipeline, which is multiples of the current backlog. And now we start seeing the uptick in enterprise, which obviously HP has a significant presence. But the reality is that we have unique capabilities. When I think about the capabilities HP has in this particular inflection point, AI, number one, we know how to run AI at scale.
That was President and CEO of Hewlett-Packard Enterprise, HPE, Antonio Neri. I know you also caught up with him a little earlier today, Crawford. I'm wondering, though, specifically about this inflection point in AI that he mentioned. When, in your view, did Hewlett-Packard Enterprise go from being sort of like an on-premise HP GreenLake to like a company that was so focused on AI?
Yeah. So look, 70% of HP's revenue goes through what we call the channel around the world, and so they've been an enterprise supplier for quite some time. And so to me, what was one of the most interesting numbers when I spoke to Antonio, I actually talked to him after the close last night, was that 15% of the AI orders that they had came from enterprise AI. So what that tells me is that, so if you think about the AI market, it's kind of like it's like a pyramid, and at the very, very top, you've got these model builders, and these are the hyperscalers. These are the large companies you know every day. These are the Facebooks with their models. And then you've got these AI clouds, which are sort of that middle band. And those AI clouds are going to be like large governments, supercomputer installations. Don't forget, HP bought Cray a number of years ago. And so HP has massive experience servicing those customers. And then at the bottom of that pyramid, you've got the enterprise. These are companies like United Airlines, companies like American Express. These companies now represent 15% of the AI opportunity. That represents just millions and millions of places where HP can sell over time. And they've got the reach into those customers. And those customers are just starting to experiment with this technology. So now for the top of that pyramid and for the mid part of that pyramid, HP has really sophisticated technology around building, configuring, and providing the services to these products at scale with water-cooled technology, sophisticated power management technology. When you start going down that pyramid, those customers are going to start building out larger and larger and larger installations, and HP wants to bring that prowess down to that set of customers. And I think we're starting to see some interesting stuff in financial services. We're starting to see it in healthcare. We're starting to see it in retail. But think about it. You've got a dozen verticals that really matter in the world. And all those verticals are going to start experimenting with AI. And that's where HP really wants to differentiate, helping those customers install, configure, and stand up those systems over time. And that journey is now just getting started.
Crawford, really appreciate you taking the time and joining us on Bloomberg Businessweek today. Crawford Del Prete, president over at IDC, also known as International Data Corp, joining us from Massachusetts.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
Well, tick-tock, everyone. About 18 minutes to the close of U.S. trading on this Wednesday, June 5th. And it's time for Drive to the Close. Very, very pleased to have with us Vance Howard in the flesh here in the Bloomberg Interactive Brokers studio. He is CEO at Howard Capital Management. Vance, how are you?
I'm very good, Tim. Thank you. Thank you for having me.
What brings you to New York, apart from gracing us with your presence here on Bloomberg Businessweek?
Well, you know, if you're invited to come on Bloomberg, you got to show up.
Oh, I love it.
It's a place to be. I mean, you got the most beautiful building in the city. I mean, it's just fun.
Honestly, we love having you, and we love having you in the studio. I should note that you've got about $5.5 billion in assets under management. I got to be honest with you. There are two reasons why we love having you on the program. One, you go specific with stocks that you like. You tell us names. Not everybody gives us names. And two, it's the HCM byline.
Yeah.
We got to learn more about this. Can you tell it for those of us who are coming in fresh all about this proprietary tool and just how special it is?
Well, we're very much a quant-driven shop, and we're very much mathematically driven. We try to take the emotions out of the equation. And the thing about the HCM byline, it's an intermediate-term trend indicator. And I tell people repeatedly, there's two things you don't want to fight. Normally, you don't want to fight the Fed, right? Well, too many people want to fight the trend. If the trend's up, just let the noise slide away and take some trades and make some money. I've seen more people lose out on being multimillionaires because they wouldn't take enough risk. And if they would just follow the trend, they would be fine. And so that's what the HCM byline does. It takes the emotions out, keeps you in the market when it's going up, even if it gets a little sloppy. That doesn't mean sell. Usually, like what's going on now, we've been telling our investors that any pullback's a viable opportunity. Buy.
How big of a pullback is an opportunity?
It doesn't really matter. We got that little 4% pullback that we had a month and a half ago.
Yeah, April was in hindsight a pretty good opportunity.
It was very good. We added money. We were 100% invested. We got a little bit more than 100%.
So. What's the HCM byline telling you right now?
It's saying buy. This thing's going higher.
AI or everything?
Everything. Okay. Well, this is the beautiful part. Let's talk about that for a second, because over the past week to 2 weeks is the first time we've really started to see the market spread out. Small caps look like they may be starting to want to do something which haven't done anything for a while. Look at biotech. Biotech's actually starting to have some 52-week highs, like, Merck's starting to get close, and Moderna's looking strong. Regeneron's it just broke out to a 52-week high. And if you don't want to play the individual stocks, look at IBB.
Okay, so we'll talk about some of these names in a minute, but I want to stick on the byline and what it's telling you, because you said you're 100% invested roughly in the market right now. At what point are you going to start to take a little bit of that cash and put it on the sidelines for more opportunities?
Not until the byline goes negative. We will stay long this market until the byline goes negative.
And again, explain the inputs to the byline.
The inputs to the byline, it mainly is a trend indicator, and what it does is averages all the different indexes together that we find important. And so it's not a short-term indicator. It's very much an intermediate-term indicator.
What's an intermediate term?
Well, I would say anywhere from 1 year to 2 years before you get it. So it'll last for quite a long time. And the markets don't run forever before they want to have a modest correction. We all get that. We all understand that. But those aren't bad things. If you pull some money off and let it sell off and buy back in, it's a wonderful thing. So you just need to have some sort of mathematical ability to be able to gauge these things, because emotions kill you. You'll lose off trading off what you think. What you think is usually rarely what happens.
But if you're talking about like so much of the thesis here is really going with the trend, obviously, like you just said, not everything lasts forever.
Right.
So how do you call the top or call the bottom? How do you know?
We've never called a top or bottom. We never do that. And when you have a trend indicator, you're never going to call the top or bottom. It's always going to have to sell off to some degree before the trend changes. And on an uptrend, when it turns back up, there's going to have to be some lift up in the market before it turns back to a positive trend. But the goal is to try to catch the turn as best you can on the down to save yourself, and on the turn back up to catch it as close as you can to the turn.
Okay, you've got how many years have you been using the byline indicator?
We've been going on 25 years now. It's a long, and of course we've always tried to make it better.
Give the track record. You have the track record.
Yeah, it's got a 73% hit rate, about a 27% when it's wrong. But the good part is it doesn't stay wrong. It reverses course pretty quickly. So if you're wrong, you don't stay long for very long.
Was it around in the .com bubble?
It was. It did wonderful.
Yeah, really? Okay. It knew that the trend was ending.
Well, I can tell you exactly what it did. We went to cash on January the 7th of 2008. We came back into the market on March of 2009. Virtually missed almost everything. I think our accounts were down about 1.5% in 2008.
Oh.
When was the time in the 27% when it got wrong and you made a mistake?
2022. It's been through 5 bear markets. And I tell people this, we're not perfect. The byline's not perfect. They don't make a perfect system. But we've been through 5 bear markets. We've done very, very well in 4. And in 2022, for the first time, we were average.
Well, that's when a lot of people were calling for a recession to start, right? Is that what was, to take us back then?
Well, there was a lot of whipsaw in there. And you had, this is the first time we've seen the Fed really raise interest rates, and it hammered bonds, just absolutely thrashed bonds. And so it was a really interesting time to trade, and it's just one of those things. Nothing's perfect. We're not perfect, but, I'll take 80%, on a bear market.
So can folks get access to the HCM byline through ETF exposure?
They can. We've got 2 of our ETFs trade off the HCM byline. And all of our funds do. So, we scale out when the byline's negative.
Do you also, you also take individual clients, high net worth individuals?
We have one of our fastest growing divisions, and we started about 4 years ago, was our private wealth services division, which has, I think it's a $5 million minimum. But we do deal with a lot of the high net worth individuals. And I got to tell you, I enjoy them a lot. I enjoy everybody a lot. But your high net worth individuals, a lot of times they're doing not only they wealthy people, but they're doing very interesting things with their lives. So they're fun to be around. You know, they're out there.
But most of the assets you have under management are in your mutual funds.
A lot of it is, yeah, but our high net worth is growing, really quick.
Okay, let's talk about some of these companies.
I was just going to say, let's get into some of these stocks. So you talked about a few of the biotech ones before in Merck and Moderna. We also got Regeneron in here. What's the outtake right now on the biotech and healthcare space?
So what's the outlook?
Yes, sorry.
Well, like I said, this is very encouraging. And what I've seen now is the market starting to broaden out. We've had the Magnificent Seven carrying this thing for a couple of years now. And I think what's going on now, and I talked about it in my last newsletter, is that you look at the 20-year treasuries have dropped down. I think that interest rates are going to start to drop organically. That means that bonds are going to start to move higher, which is quite interesting. But as interest rates start to drop, this market's going to broaden out to small caps, mid caps, and different sectors of the markets. Biotech has not done well the past 2 years, but it is starting to look better and better to us now. So as the market broadens out, I think there's a lot more opportunity for people.
Yeah, and you also flagged the iShares Biotechnology ETF, so you can probably get some exposure that way too.
Well, it's like I tell people all the time, if you don't want to pick an individual stock, just get the whole thing. Yeah. Get all of them in one. And let me tell you, this doesn't just go for individual investors. We trade ETFs all day long too, just like we would a stock. So they're wonderful. They're liquid. They're great.
All right, let's talk about Salesforce, because hard to believe it was just about a week ago when we got those numbers from the company. We only have about 30 seconds left, Vance. You got this on your list of stocks to watch.
I do.
It's been getting killed.
It has. Well, this was a gift. We didn't own it when it dropped, but this is a gift to drop this 20%. And there's so many wonderful things about Salesforce that we like. Number one, if you think about this logically, it's off 20%. This is a great company. There's a couple of things I like about it. One, they have recurring revenue. Okay. You don't have to go out and resell it every month. Every month you get a check on recurring revenue. Number two, this stock has the potential to dramatically benefit from AI. What if with AI in the next 12, 24, 36 months, they could reduce 20% of their workforce? Look at the dramatic income it's going to impact the income or their net income and their earnings. It's going to be incredible. So this stock is, I think, a roaring buy right now.
Vance Howard, we love it when you join us. Please come back soon here in our Bloomberg Interactive Brokers studio. Vance Howard, CEO over at Howard Capital Management.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.